Welcome to this explainer. Today, we're unpacking a really fascinating case study in the pharmaceutical space, Supernus Pharmaceuticals, trading under the ticker symbol SUPN. Now, if you follow the biotech sector at all, you know it's notoriously tricky to navigate. You are literally walking a tightrope. On one side, you absolutely need strong commercial sales from approved drugs to, generate cash. But on the other side, you've got to pour massive amounts of that cash right back into a highly uncertain, incredibly expensive clinical pipeline just to ensure your future survival. It's a constant balancing act. So today, we're going to look at exactly how Supernus is managing this tightrope walk, especially following their highly anticipated Q1 2026 financial results. Okay, let's take a quick look at our roadmap. We'll be hitting four main areas today. First, the Supernus market position. Second, their Q1 commercial revenue drivers. Third, the clinical pipeline. And finally, the financials and what Wall Street is saying. Let's dive right in. Section 1, the Supernus market position, a historical outperformer in CNS therapies. So Supernus focuses exclusively on central nervous system or CNS diseases. We're talking everything from ADHD and Parkinson's to epilepsy and major depressive disorder. It's an incredibly tough field, right? But their historical market dominance is pretty clear-cut. To put that into perspective, imagine you made a hypothetical $100 investment at the end of 2020. By 2025, that investment ended up at almost $200, $197.54 to be exact. They completely left the broader NASDAQ composite and the NASDAQ Biotechnology Index in the dust, with those indexes ending at just $124.75 over that exact same period. It really proves their ability to reward long-term shareholders. Moving on to Section 2, Q1 commercial revenue drivers. Explosive growth in action. Right now, their engine is running incredibly hot. The absolute crucial data point you need to know is this massive 39% year-over-year jump in total revenues. Think about that. For just the first quarter of 2026, Supernus brought in a staggering $207.7 million. I mean, for a company with a market cap of around $2.7 billion, generating nearly $210 million in a single quarter, that is a major milestone, and honestly, a massive acceleration from the $149.8 million they posted back in Q1 of 2025. And you know what's really great? This revenue isn't just coming from like one lucky blockbuster drug. It's a properly diversified portfolio. Let's break it down. Qelbree, their ADHD medication, jumped 20% to nearly $78 million, and that was driven by an all-time high of around 43,000 prescribers. Then you've got Gocovri, which treats involuntary movements in Parkinson's patients. That grew a really solid 15%. But the real standout, the game changer here, is Zurzuvae. It's a postpartum depression treatment they're collaborating on with Biogen. Supernus gets 50% of the net revenues, and that partnership brought in a completely new, incremental $27.6 million this quarter alone. Oh, and we definitely can't forget the resurgence of Onupgo. This is their treatment for Parkinson's disease motor fluctuations. They resumed new patient initiations in February 2026, and boom, it immediately contributed $8.4 million to the top line. The demand is actually explosive. They've had over 2,200 enrollment forms submitted by more than 645 prescribers since its initial launch. In fact, it's taking off so fast, they're literally rushing a regulatory submission to the FDA just to get a second supplier online later in 2026 so they can keep up with the demand. So when you aggregate all of those individual drug performances, you get a very, very happy executive team. Jack Cotter, the president and CEO, hit the nail on the head during the earnings call saying, "Our first quarter results reflect a strong start to the year, including a 56% year-over-year increase in combined revenues of our growth products." That kind of momentum across four key products is exactly what you want to see from the commercial side of a biotech business. All right, Section 3, the clinical pipeline, funding future discoveries. Now we're back to that ultimate biotech dilemma we talked about. It's essentially an engine on one side and your destination on the other. Your engine is the record-breaking sales of current drugs like Qelbree and Gocovri, but you can't just rest on your laurels. Why? Because patents eventually expire and generic drugs will inevitably flood the market. Actually, scratch that. It's not just inevitable, it's happening right now to Supernus, with older drugs like Trokendi XR. So what do? You have to take the cash from your current engine and relentlessly funnel it into the right side of the equation, the clinical pipeline. And Supernus is funding some incredibly ambitious projects right now. SPN 817 and SPN 820 are both sitting in phase 2B trials. For those not deep in the weeds, that means they're in the critical, highly expensive mid to late stages of testing for severe epilepsy and major depressive disorder. They're also kicking off an early-stage phase 1 study for SPN 443, which is a novel stimulant for ADHD. Now, pushing these complex therapies through the rigorous FDA gauntlet, it costs an absolute fortune, which perfectly tees up our final chapter. Section 4, Financials in Wall Street, the cost of growth. Okay, we just talked about their massive top-line success, bringing in over $207 million in a single quarter. But as any seasoned investor knows, revenue doesn't automatically equal bottom-line profit. And here is the reality check. Despite all that record revenue, Supernus actually posted an $8.3 million operating loss in Q1 of 2026. Why? Well, it's exactly what we just discussed. They dropped $39.4 million purely on research and development for those pipeline drugs. And on top of that, their SG&A expenses, that's the actual cost of marketing and selling their current commercial drugs, ballooned to $125 million, which was largely tied to that new Biogen collaboration. Basically, growth is not cheap. But don't panic. Thankfully, the company is sitting on a formidable war chest to absorb those operating losses. As of March 2026, Supernus is holding a massive $384.2 million in cash, cash equivalents, and current marketable securities. This is huge. It means they have the vital financial runway they need to fund those incredibly expensive Phase 2 and Phase 3 trials without having to immediately dilute shareholders by going out and raising new capital. So how is the professional financial community looking at this whole balancing act? Well, Wall Street seems pretty darn optimistic. Analysts maintain a consensus strong buy rating on the stock. We're talking 5 buys, 1 hold, and 0 sells. The median price target sits at $64.00, which implies a really healthy potential upside of almost 37% from current levels. And if you glance at their forward price-to-earnings ratio of 18.36x, it's clear analysts fully expect these current operating losses to flip into solid profitability pretty soon, as that revenue growth eventually outpaces their fixed R&D costs. All of this brings us to the million-dollar question for anyone tracking this space. Can Supernus actually convert its undeniable commercial momentum and its clinical pipeline promise into consistent long-term profitability? Look, they've got the revenue engine firing, they have the cash runway, and they definitely have the historic pedigree in CNS therapies. But in the wild, unpredictable world of biotech, the final verdict always rests on those clinical trial results. It's a fascinating stock to monitor, and it just perfectly captures the high-risk, high-reward nature of modern medical innovation. Thank you so much for joining me for this explainer, and as always, keep your eyes on the data.